Hey everybody, welcome to the first live of 2022. I feel like there should be like strobe lights or something or music playing or something, but funny part about it is usually the first part of the live stream, you don't see anybody anyway, so I'm just doing this for myself anyway, so I should make a part out of it. I'm Tristan Emond with Mindful Living Realty. Welcome back to my YouTube channel where I talk everything about moving to Rapid City, and the wonderful thing is about Rapid City and the Black Hills. Today we're going to talk about what's going to happen in 2022. Specifically, of course, the real estate market. Let's talk about where things are going to go and how things are going to happen. I just wanted to give a shout out to everybody who noticed my post on YouTube the other day regarding we were out of town and got stuck at the airport. Yeah, it was a kind of a fun trip to Arizona. And we thought, hey, we're in South Dakota. Let's go to Arizona. It'll be warm, right? Yeah, not so much. We decided while we were there, we would go and we would visit the Grand Canyon. And that was our visit to the Grand Canyon. It was 30 degrees. We could see absolutely nothing. We might as well have stayed home instead of doing that. But it's still an adventure nonetheless. We went and scurried back down to Phoenix where it was 50 degrees and the sun was shining a little bit more and enjoyed the weekend down there. But then, I got stuck in with a canceled flight and ended up driving home across the middle of the United States, which was interesting, of course. I have never been through New Mexico, so that worked out okay. So, but without further blah blah, I would like to introduce the guest on our live today, and that's Angelia Dale. I've been working with her for a number of years with Gateway Mortgage, and here she is as soon as I hit the right buttons. Hello.
Hello.
Angel's here. Welcome.
Thanks.
So
now everything's working.
Yeah, right. We spent some time trying to figure out how to get her camera and her microphone to work. Turns out it was driver's error, of course. So anyway, Angela, tell us a little bit more about who you are, how long you've been in the mortgage business, that kind of stuff.
Okay. Well, I'm with Gateway Mortgage, which is in Rapid City, Spearfish, and Sturgis. And I have been with them since March of 2017, so going on 5 years. But I've been in the mortgage business since 2004. I've been working for banks and brokers, and just kind of love the industry, helping people get into a house.
And we've been connected I was trying to figure that out,
at least 6 years.
It was a year, but at least a year, because we kind of first got connected before you got to Gateway. So
correct.
Yep. A year or so.
Yeah, it's been a little while because I was mainly up in the northern hills, like the Spearfish, Lee Deadwood, Sturgis area when I was working for the bank. And then I started working for Omni for a short amount of time and got into Rapid City. That's when we started making our connection.
Oh, okay.
So roughly 2016, I think.
Yeah. Wow. Okay. Yeah. And we've used Angela on a number of transactions, and we work well together because we both kind of have the same attitude of helping people first, and everything else is kind of secondary. So she's going to talk to us a little bit this evening. We're going to talk about interest rates to begin with, because obviously when it comes to purchase power and where your finances are, everything's going to be, interest rate plays a huge part in that. So where are things headed? What do you see? What takes down the road?
Well, we've definitely been in the lows for the last 2 to 3 years, and we're starting to kind of see them slowly increase. Now, granted, I say that, and the rates are still good. 3.375, 3.5 is still an awesome rate. But, when you had the high twos and low threes and things like that, it's kind of a shocker initially, but they're still good rates. They are definitely going to start moving. The market thought they'd start moving kind of like the second quarter, but we have definitely seen some increase in the last couple of weeks.
Even in the last couple of weeks, you've seen some increase.
Oh, yeah. We've had some...
A minor, just a little
just
point.
Minor, yeah. Between that eighth of a point to a quarter of a point, but it's enough to start really watching. If people are on the fence and really want to kind of keep it below that, 3.5, 3.75 rate, it's a good time to start really kind of lock it in if you can get into a house. And we kind of have a nice program if it's a primary residence. It's called Lock and Shop, where you can actually lock in a rate for 30 days while you're looking for a property. And then if it will adjust if it goes better, it will adjust. If it goes higher, you'll stay at that rate that we actually locked in. So, it's a good option to have because they're definitely moving.
That's What do you? I suppose you listen to the peoples, the economists. Are they predicting definite increases over the next year, or what are they saying?
Yes, the Feds are looking at they've talked about increasing the rates at least 4 times this year. I mean, the Fed rates at least. So, we were, the end of last year, we were thinking we're going to be probably about 4% maybe at the second, third quarter of the year. So it's definitely on the rise.
Okay. So, but it's not going to be into 7 or 8% or nothing.
No, we're not going to see that. No, and then we'll watch, obviously with inflation and stuff like that. The beginning of this week, the rates were higher, and then Powell came out with some of his unemployment numbers, and we came down a little bit on, say, Wednesday and Thursday. So there's definitely a trend. The middle of the week is usually a better time to lock rather than the end of the week because you don't know what's going to happen over the weekend and things like that. So
Gotcha. Chris has got a question here. So with that lock that you were mentioning, does that work with a new home build, or how does that work?
Well, so our new home build, we actually came out with a program. It's called an extended lock program where, because especially with new builds, everything is being pushed out because of materials and time and things like that. So we have what's called an extended lock program. We can go out from 90 days to 360 days lock. It is a 1% fee upfront that you get reimbursed at closing because we don't want you to take off and go to another lender. We'd like to have that relationship. So there's a 1% fee for that, but that allows you to lock out further, especially with the way the market is right now.
Right. And
but those are only on.
Certainly helps also with all the, new construction has been a mess with the delays and everything. So
yeah, you can't really predict, you're going to be done in 3 months and things like that. So if you can go in and do an extension and things like that. If the market comes down and that rate has been locked, if it does come down, there's an option to float down a little bit there. But at least if if you're not going to be done till July, it's kind of a nice option to have because we don't know where rates are going to be like that in July.
Okay, so with your 30-day shop rate deal, so you jump in at 3%, let's say, and you move forward and you buy property or you put property under contract, then you're guaranteed that, or I don't know if guarantee is the right word, that 3% rate until purchase, or is there a?
Yep. So you get 30 days to start looking or shopping for a home. If you find a home within that 30-day period, then you put in your purchase agreement, and then we get you locked into a rate, or you have that rate that we locked you in initially, and then we can extend it for another 45 days to get you through.
Is there any fees to that?
Not to that one, not to the lock and shop, no. But there is for that extended program.
Gotcha. Okay. Good to know. Hey, boy, you even got into locks without even me getting there. Nice. I didn't have to.
It's an important topic right now. It really is because, we normally lock, we have up to 60 days to lock on an existing property. And, usually those have been going, our appraisals and stuff like that have gotten a little bit faster. But, if you're still shopping, and especially if it's your primary residence, that lock and shop might be a really good option. So
right. Obviously, you really want to be ready to buy. I mean, you got to have, okay, we're going to do this and we're going to do this now kind of attitude.
You'll be pre-qualified, which we'll kind of talk about later, but getting in and get pre-qualified, and then we get that lock and shop off a to be determined address.
Okay, perfect. Okay. Yeah. So you kind of, as we're talking about interest rates, the one thing I want to pull up here real quick, if I can do it right, is this little wonderful little graphic I made here. I just found this on the internet, right? Oh, I just want to play my little graphic. Come on. It didn't like me. Now I got to find it again.
Oh, there's Sarah.
Yep, Sarah on the beach. We'll talk a little bit about, let's see, I've got this. Okay, there it is. Let's try this again. There we go. So you can see the difference here between on a $300,000 property. So you can see the difference between 3%, 4%, and 5%. And this is not talking down payments. We're not talking any goofy stuff. We're just talking straight up math, right? So 3% is about $2,071. Another percent gets you almost $200 more on a payment. So that really is going to affect your purchase power or how much you can buy.
Correct.
Or your payment, right? if it gets up to 5%, we're looking at almost, a good $300 more over what's already been, So I mean, if you're still looking at 2,000, if that's all you can spend per month, that's really going to dock how much money you can spend up here. So certainly, as rates go up, that's going to affect purchase power in the future. And obviously, with these stupid, crazy prices around here, that's not going to help affordability anytime soon or none. So,
yeah,
double right.
Yeah, because when we look at a lot of people ask about debt to income ratios, and a lot of people have the perception you have to be about 35% debt to income ratio. Well, that's a nice number and a good option to have, but we can actually, most programs are conventional, allow us to go up to a 50% debt to income ratio. Granted, you don't want to be house poor, so it's where you have to be comfortable with that payment. But yeah, I mean, like you said, the way the housing market is coming in and the higher interest rates, it's going to be hard to, afford that first-time home.
Sure, 100%. Okay. Since we mentioned down payments, let's kind of talk a little bit about down payments. I know, kind of per program, maybe per se, or where are down payments kind of coming in at? What's the minimum required, that kind of thing.
So we have two programs that are a 0% down program. It's a rural development program, which you don't have to have cows and chickens and stuff like that. You just can't be within a certain population, like Rapid City and Sioux Falls. Those can't do rural development, but Lee, Deadwood, that kind of thing, that can do rural development. It's based on income and household size. And then that's a 0% down. And then we have
that's got a cap too, doesn't it? An income cap, or
it's capped on conventional.
Okay.
Yep. So that one's capped on conventional, which conventional right now is 647,200. It just changed the beginning of the year. Yep. And then we have VA, which if you're VA eligible or National Guard eligible, that's 0% down. Now, granted, I say 0% down, but you still have closing costs. That's become an issue sometimes. People don't realize you still have closing costs and prepaids, so you have some money to come in possibly with the closing of the house. But those are the two programs that have no money down. And then we get into, we have a couple conventional programs, which are 3% down, if you get the guidelines on that. And then usually minimum conventional are 5% down. So conventional, you can go as low as 3, and then however high you can get up to, you want to go up to. And then we get into FHA, which is 3.5% down.
Right. Okay. So certainly not off the wall on this 20% business, right?
You don't have to have 20% down. It's still amazing. It's like a lot of people hear that.
We still say we don't need 20% down.
Do not need. Yeah, it's like one of those things.
Okay. Yep. So let's move on to the next thing and just talk a little bit about the pre-approval process. So I say, hey, call Angela. She'll help you. Obviously it's not a scary process, but what do you do kind of at the get-go? What are you looking for? What do you need? Kind of give that information.
So actually it's a pre-qualification initially. And what that entails is doing an application, pulling credit. If you're not self-employed, you can put in what your hourly income is, how many hours of work you work, and then assets. And really from there, it takes about 20 to 30 minutes to get somebody pre-qualified based on what they put on the application. And then we go into the pre-qualification or pre-approval, which it makes the transition a lot smoother if you can get pre-approved. And that is where we get 30 days of pay stubs, need 2 months of bank statements, and all pages, because a lot of people send them in and they don't send that last page because there's nothing on it. Well, we still need that because we don't know there's nothing on it. And then if you are self-employed, 2 years of tax returns, because then we have to calculate your income. Now, self-employed people have gotten a little bit more paperwork because of COVID. Because of COVID, the guidelines have changed where we need 3 months of P&Ls and then 3 months of business bank statements to make sure you're still in the black for a self-employed business. And then usually that's about it. So, 30 days of pay stubs, 2 months of bank statements, and then if you happen to be self-employed, tax returns.
Right. But if you leastwise get the easy stuff done for the pre-qual, and we can get going anyway. So, and then we can get the pre-approval going kind of.
Yeah, because then we can check credit to make sure credit looks good. A difference between pre-qual and a pre-approval is a pre-qual is I'm just taking it basically off that application. A pre-approval, it's actually gone to the underwriter, and the underwriter has reviewed everything that we have submitted in, and they're like, okay, everything is good. Now we're just waiting on the property and the title work and homeowners insurance.
Gotcha. Perfect. Okay. So another big question a lot of people have asked, and this is about the jobs that are required for loans. So a lot of people coming in out of state, they're saying, hey, I'm looking for a job. I'm going to get a job. I have a self-employment. What's with the job thing?
And that has been huge for the last year with a lot of people coming in, and especially again with COVID, more people can work remotely.
Right.
So the biggest thing is first we ask them is, okay, where's your employment coming? Do you have fixed income, which is Social Security, retirement, or pension? That's kind of a given. That's going to be there no matter what state you live in. If they don't have that, then we can ask them if they can work remotely. So if their company now allows them to work out of their home office, we get a letter that says they can work remotely. Those people who cannot work remotely and they're coming into kind of the same field, we usually get an employment offer letter. That employment offer letter needs to have no contingencies, or at least those contingencies have to be removed before we go to closing, to show that, if you have a background check that you have to do, or you have a drug test that you have to do, that you've passed that job. Yeah. Right. And then it needs to state how many hours you're going to be working, and then your pay rate on that side. So those are pretty easy to get, and they have to be signed by both employer and the borrower, and then they have to be on letterhead. You don't
have to have like a month's worth of pay stubs or nothing. Correct. As long as you're going within same job to same job-ish, right?
Yeah, and you can change jobs. Like I have had some people who've come in and they, say worked at an oil company, and then they were training for an EMT. As long as I can show that they have an employment offer letter or something, and they've changed careers, sometimes we have to show that they've had training to change those careers, especially in their government programs. But usually we can get documentation on that.
Okay. But if you decide, hey, I'm a nurse and I'm going to now be a painting contractor, that's probably not going to fly.
No. And, we've had a lot of self-employed borrowers come in, and some of the income, like, for example, I've had somebody who moved from Arizona who was a massage therapist, but she was also selling like Young Living oils. So I couldn't use her massage income because you have to reestablish clientele in South Dakota. But the Young Living oil, I was able to use that income because it was a web-based program. So it's really getting that borrower. And I'd say every borrower is like a puzzle. It's like, I take your life and I try to put it together and make sure it makes sense to loan you $300,000 or $500,000.
Well, that sounds fun. Thanks.
Some people are 5 pieces of puzzle. Some people are 1,000 pieces of puzzle, but it keeps my life interesting.
Just to reiterate on your self-employment people, you're talking about the people that are have the business here and want to take that business and operate it and move it into Rapid City. And that would require more than just, you'd have to show that the business in Rapid City, I assume, and gaining income rather than.
Yeah, and each one is an individual one, because like I said, the massage therapist, I couldn't show that she was going to be able to reestablish her right away because she had to build up clientele. I've had a construction company who is starting to build up here. They're going to keep their main office in California and move up here. So then I was able to use their income. So again, it's an individual basis that we have to.
Office. Yeah.
Exactly. Yeah. Okay. Yeah. So we really have to take them. And that's where that conditional approval comes in. I'm really big on, let's find out the answers in advance so that we don't get you pre-qualified halfway through the loan. You find a perfect house, and then guess what? We can't use that income. That's a heartache for everybody.
Gotcha. Yeah. And this is what I've always been telling everybody. If you haven't heard my spiel already, is get pre-approved now or get pre-qualified now, because the information that you have put in now, and if something pops up and you see it, I love that place. If you need to spend 3, 4, 5 days getting all this stuff in just to make sure that everything works, you've lost it. You've lost the house.
Yeah.
So exactly. You want to make sure that you have everything in place. And I'm assuming, I know that you talk about your pre-qualification letters only lasting so many days. But to re-up that is certainly a lot easier than it is to do the whole process over again.
Very much so. Because, exactly. It takes, our pre-quals are good for, our pre-approvals actually are good for 120 days after we pull credit. If we have to update credit or pay subs once we're along that route, perfect, But if we get to the point that, okay, I'm dragging my feet, I'm not doing an application, and then you find that perfect house, I pull credit. What if your credit scores are not where they need to be, or
you have no way to use it?
Yeah, a lot of people don't realize when we look at your paycheck, if it doesn't say 40 hours a week and it's normally 36, that becomes variable income, and then we have to have a 2-year history to make variable because you're not averaging a 40-hour work week. So those are a lot of those little things. It's really good to look at in advance so that your pre-qualification or pre-approval is a smooth transaction.
Right. Yep. That makes sense. Yeah. And I think a lot of people are always concerned that, well, I haven't found anything yet, so I'm not going to, but you need to get everything worked out first to make sure you know where you're at, so that when something pops, you can jump on it.
Yeah, exactly. Especially with credit. We have some people who come in and have maybe not the best stellar credit, and we can give them a couple directions on what to do. And it might take, 10 days. If we do a rescore, it might take, 30 days to 90 days, but at least we can kind of get you on the right path so that you are ready when the time comes.
Yep. Awesome. Okay. Let's kind of scoot back around to where the market is. And I know that you've talked with other buyers and stuff. What have you been hearing about prices and things that are happening and multiple offers?
It has been crazy this last year for, I've been in the industry since 2004, and I've never seen the increase on, if the house is actually $330 and people are offering $350 and getting that for a purchase price. That's kind of unheard of, but until the last year. The other part is, seeing houses, sometimes they might not come in at value and people are paying, $10,000 over the value of that house. Yeah. But if they have that cash, they could definitely do that. And we can get you qualified that way. So it is crazy because, like I said, there's not as much inventory. I've done more construction loans this year than 2021 than I have since I've been in the business, because there's not a lot on the market, and then the prices they are. I've had somebody who bought a house a little over a year ago and sold at the beginning of 2020, the end of 2020, for almost $100,000 more with not doing any improvements to it.
Yeah.
So it's low inventory and higher prices, definitely, because our minimum used to be 150, and I think we're pretty close to 250, 225 right now for like a starter home.
Yeah, right.
That doesn't need.
Well, I did a search the other day. I just open up the MLS portal. I type in active residential and see how many are total. And there was under 200. And then I defined it down to just Rapid City. And it was like, I think it was 29. And then when I got rid of all the new constructions, the active number of pre-owned homes in Rapid City available for sale right now is 19.
And you have 200 people going after those 19 houses, so you have multiple offers on everything.
I showed a property here earlier today in Box Elder. It was, I think, just went on the market yesterday. I looked at it at 10:30 this morning. They already had 2 offers. I got an email later on today about the number of offers they got. So I mean, it's not slowing down, and I don't anticipate it slowing down at all this year, based upon everything that I've seen.
No, and I don't think, like I said, the rates still being a little bit higher than they were, they're still good. And I kind of laugh about it. I've been in my house for 20 years and I had 3.875 up to last September. 3.875 wasn't bad on a 30-year fixed. And, I finally refinanced, but they're not terrible rates if you look at the overall scheme. Yeah, we start getting into 6s and stuff like that where we should be squirming a little bit, but I don't foresee that at all.
At least was this year.
Hopefully not in the next 10 years, but who knows? It depends on where we go. Yeah, I've heard about the double digits. I haven't seen those yet, nor do I want to.
Yeah, I don't want to go through those scare days. That doesn't sound good to me at all. So,
no.
Yeah, no. I mean, I remember we've had this actually lower stuff for, I don't know, it seems like for the past 5 years, I've kind of been saying, well, they've got to go up sometime. And
yeah. And they
but
just
it
been
sounds
kind of
like
saying,
this is the time. So, and I
yeah,
realize, especially for a lot of people that are on my channel that could be watching this, is that, you're not in a position to say, oh, the interest rates, let's go now. You've got to wait for, your home to sell or things to line up, or all these different things, all these pieces to come into place. So, it's nothing we're doing. We're not trying to do anything here to say, go buy now. We're just trying to say, hey, things might be changing here in the near future.
be aware of it. Yeah.
Just be aware of it. Yeah.
Yeah, because like I said, it does affect your purchase, your buying power in a sense. And it's like, if you are comfortable and you want that $1,600 payment, where are you going to be at for a price range to get that?
Right. And hopefully we can get you locked in sooner rather than later to keep that what you need to be. Cool.
Yeah. Yep.
All right. I think we've kind of covered a lot of things. What anybody on the comments? There's like a few people watching now. If anybody wants to check, there we go, right here. Boom. Thanks, RJ. Appreciate the question. What's the biggest factor calculating your interest rate? What goes into that?
Usually, it starts with your interest rate, or your credit score. Your credit score kind of is that big factor. The FHA, that kind of thing, will take you down to a 585 credit score. VA will go down, I believe, 585, and then it slowly moves up in regards to interest rates. You kind of hit 680, ideally 700 when we start to get in your conventional programs and things like that. You cap yourself at, I think it's like 725, 750, and then the interest rates aren't going to change based on your credit score. So you could have an 823, and you're going to still get that same interest rate as somebody at 750. So that's the beginning of it. The other part of it really factors in your kind of your loan to value. If you have 5% down, if you have 50% down, that kind of thing. Okay. So
does debt to income have anything to do with that interest rate? Okay.
No. The debt to income is mainly what type of program we're going to put you into. The higher debt to income ratios, because FHA will actually allow you to go up to like a 55, 56% debt to income ratio, where conventional keeps you at that 50%.
Right. And then there are other things such as like South Dakota Housing. They still have interest rate programs where you can pay an extra percentage point for this or that or the other, and they've got different kind of options, 3.5% for gifting funds or something.
Yep. So South Dakota Housing, I think back, I want to say it was April, they realized that because it's definitely a seller's market right now, that people are not giving up seller paid closing costs. Right. So if you need 3% to get in a house, but you don't have closing costs, you're still not getting into a house. So they gave a program where you could do 3% down, or they could do a 5% down. And that sits as a silent second on your mortgage. You don't make any payment on it. It's not due until either you sell your home, you refinance, or you pay it off in that 30-year period. So, but it is nice because a lot of people, they might not have that, 8.5%, 8% total for closing costs and the down payment if they need it. Right. And then they do have some programs. It's based off of government loans and then versus conventional. And then they also have what's called an MCC tax credit program. It's kind of like the child care tax program that they have. So if you're a first time home buyer and you meet those guidelines, then you could get up to $2,000 depending on the purchase price of your house every year back on your taxes. So it's kind of a nice program. And their rates are still going up. I think they were at 4.125, actually 3.75 on their conventional loan with the 5% down. So
okay, cool. Yeah. So moral of this story is ask questions, because there's
a lot of questions.
There've been more and more programs come alive. I mean, back after in 2010 they shut them all down, and it seems like they're kind of coming back alive now with different options and stuff. So.
Yeah, you really need to ask, because if you are just saying, okay, or if your lender is saying we're putting you in an FHA, if they don't give you a couple options, we really need to want to question and maybe shop around and see what is available, because some lenders don't do South Dakota Housing, some lenders do. And there's other programs out there like South Dakota Grow, which can actually go with South Dakota Housing. So there's South Dakota Housing, and then you could do South Dakota Grow, and then you could do your regular mortgage. So there's a couple different loan programs out there.
Kind of stack them on top of
each other. Yeah. If you need to stack them, yes. I'm not a big fan of having 3 different mortgages on the file.
Yeah, they have to pay off at some point. Yeah. So Sam's asked, mobile homes. How does that work?
So we do get a lot of those questions. So single wide in a trailer park, no go. Okay, it has to be like Gateways has guidelines that it has to at least be a double wide. It has to be on a permanent foundation, and then it only can be moved once. So it has to go from the dealership to the lot, and then and we can show HUD tags for that, and we have a way to find out if it was moved and things like that. But really, we can do South Dakota housing, we could do VA, could do conventional, and we could do FHA with a mobile home.
Okay, so there are options with the double wide on foundation.
Yes. Yep. If you want a single wide in a lot, I'll send you to a different lender.
Right. So, and in South Dakota, mobile homes are basically big cars. That's how they're registered.
Exactly. And that's why we want you to put them on a permanent foundation, because they come with a registration and title. So once you put it on that permanent foundation, then it becomes real estate. It becomes real property. So it's tied to the ground. So then your tax is one, plus you can't take it off.
Right. And this is different than a modular home too, because a modular is the same it's still mobile, but it's built off site and moved on, but it's always moved on to a permanent foundation. So that still has the same financing ability as everything else.
Correct. A modular to us is considered a stick-built house.
Awesome. Yep. Okay. Yep. So also, Samuel, on when in regards to mobile homes, if there's any kind of single wide and anything even older than sometimes even 70s, there
1976.
Some financing will help you, but it's like bank financing, and the interest rates are higher and they're shorter term. So by the time you end up spending, by the time you get your payment on the mobile home, it's not really cheap anymore, because all of a sudden you're paying $1,000 a month on the single wide mobile home. So that's kind of how that works.
Yeah, and our interest rates on mobile homes are pretty good. They're slightly higher than a conventional because it's a manufactured home, but they're on 30-year fix still.
Yeah. Okay.
So it's kind of nice.
So certainly an option.
Yes.
And do you have mobile home building? So if I want to buy a piece of land, I want to put a mobile home on it. Do you have a construction type program, or?
We don't with Gateway, because we have a really great single close construction loan with Gateway. The problem is with Gateway, the way we need to be paid out for our contractors is they want to like if you were building a stick built, you put in the foundation, you get paid for that. You put in the framing, you get paid for that. When you put in a manufactured home, they bring it in, you pay for the foundation, and then they put the house on it, and you're paid, and you're done. So there's not that process through the draws. So we don't have an option for like those are like kit homes yet from like Connects and things like that. Yeah. If your builder is willing to work with you like in a modular home in a sense, then as long as they're willing to kind of take payments along the way, then we can look at doing that. Pole barns, that kind of thing, are again, ask questions that unique area that we can see if we can figure out how to make it work.
Okay, you mentioned. So what about barn dominiums?
Yep, we can do a barn dominium, but that gets, because some of those barn dominiums, say if they come, like if they get them from Connects or Menards, they bring you the whole packet, and they want to be paid up front for that packet. As long as you can, either you have the cash to pay for that packet, say the $100 or $100,000 it would cost for the materials, then the builder would put them up, then we could do the loan. Or if you have somebody who's willing to take, draws on the process of building that barn dominium that way. Our biggest thing is we need to have the step 1, step 2, step 3, step 4 until the completion of it, rather than step 1, step 2, and we're done.
Gotcha. Okay. So an existing barn dominium, something that's already in place?
Yeah. Yes. As long as we have comps, because we're starting to see a lot more of those. So as long as we have those comparables, even one of those geodomes, a couple of those have popped up. If there's something that we can find a comparable on, usually we can pull that off.
Okay. Any benefit to a 15 mortgage versus a 30?
Oh yeah, you can do a 15-year. You're going to be paying less interest to the bank. It definitely is almost double your payment. So you want to kind of see where you're at. If people are good and they can make that payment, they're comfortable with making that payment, and their debt to income ratios could carry a 15. I'd say do a 15. Sometimes if you do a 30, if you might be a little strapped for a 15-year payment, but you could do a 30-year, you can always make that extra principal payment on it. And then say Christmas comes and you don't want to make that extra principal payment at that time, you can not make that and then continue, January or February again when you're ready to, and we'll take the term down. But 15-year is definitely going to save you more money over the long haul. Plus the interest rates are lower.
Okay. Yeah. So certainly something to ask a question about if you can, but I think there's also a little bit to be said for when the interest rates are as low as they are now, use the bank's money. I mean, there are strategies regarding that as well. Not that we are financial consultants over here, but I mean.
No. Like I said, if you can do a 30-year, throw some extra payments at it because you're probably comfortable with a 15. I would probably do that versus being at
treat it like a 15.
Yeah.
That idea, right?
Yeah.
Cool. All right. Anything else that has been asked kind of frequently that we haven't mentioned? I think we covered a bunch of questions.
Yeah, I thought. Well, it's a lot of things that are actually coming up. Like I said, a lot of people calling about those mobile homes. Can you do this? Can you do that? And then, I still get that. You have to have 20% down? Nope, you don't have to have 20% down. Definitely ask. This is, I tell a lot of people, it's like, don't be afraid to ask questions. This is a large investment. Most people go out and buy a washer and dryer and probably do more research than they do buying a house sometimes. So it's like, ask your lender. Ask them all the time. If you have a question and they said something that you don't understand, go back and ask them. This is your purchase.
Okay. Right. And guys, you can tell this is why I like Angie so much. She's like, well, talk to me, ask me. She'll have a conversation with you without you making you feel like you're, stupid or not educated or whatever. She just wants to make sure that she understands where you're coming from to help you get your package put together. And if she's not the best option for you, she'll be the one to say, hey, maybe you should go somewhere else. Like, we can't help you. I had a scenario where someone was buying some land and she actually found a lender that offered a better program. So, that's who she is. And these are the kind of people that I like to have on my team, and we do work really good together. So
we do. Communication is good. And
100%. So, all right. I think we're going to wrap this up. Thanks everybody for watching this afternoon. So I've been morning and afternoon, and it's like, what? Am I starting over again?
No, we're ready for the weekend, Tristan.
No question there. So, but as we mentioned before, interest rates sounds like they are probably going to go up a bit more here. We're not seeing things slow down. I'm not gonna. Everything I've been seeing, we've got new businesses coming in town. We've got the base is still in function. It's still coming with a new mission. I've still got a number of people looking to come into town and make Rapid City of South Dakota their home. I've talked with 3 or 4 or 5 this first couple of weeks of 2022. So nothing is slowing down. So you can just keep that in mind. Keep that in place, that we're not looking in recession. It's just that maybe the interest rates might come up and cause some affordability issues. If you can jump on things quicker, great. If not, hope things will mellow out for you when it's your time. So there we go. Yeah. Thanks, Angie. Have yourself a good evening. Take care, everybody. We'll talk to you later.